Well, welcome everyone to the first Bell Asset Management webinar for 2022. Why inflation is an opportunity for quality global SMID and mid-cap stocks. For your information, the information disclaimer page is there. Please read that while I have my introduction today. Today, you're welcome with Ned and myself. So I'm James Biggins, a Director at Channel Capital, and I've joined with Ned Bell, CIO of Bell Asset Management. Ned leads the team covering two strategies, the Bell Global Equities Fund and the Bell Global Emerging Companies Fund. Today's webinar will be running until 12:55, not the 1:15 stated in the invitation. So with that in mind, please submit your questions throughout the presentation. And if we don't address them today, myself or one of my colleagues at Channel Capital will get back to you. So from there, Ned, welcome.
Thank you.
Good to be back in the office.
Absolutely.
Now, with the return of inflation and global share markets are focused on earnings and have punished stocks with excessive valuations, could you provide a bit of a market outlook from your and the team's perspective?
Yeah, sure. So clearly, we're transitioning into a very different market environment now. I mean, I think that sort of almost goes without saying, but it is absolutely one that is going to be more and more dictated by expectations of rising inflation, rising interest rates. I think on the inflation point in particular, it's hard not to bring this whole discussion back to style. What style will work? Clearly, there's been huge divergence between value and growth in the last couple of years. Obviously, as a quality manager, we make the point we feel like quality is actually going to do really well in this environment and will actually be rewarded because essentially quality by definition consists of companies that have got pricing power. And that pricing power has not really been rewarded in the last 3 years the same way we think it will be rewarded in the next 1, 2, 3 years. So there is definitely a change going on. When it comes to valuations, I think, clearly we've seen, as you alluded to, you've seen a lot of valuation risk, materialise at the very top end of the market. So a lot of these very well-owned FANG stocks have, had huge drawdowns. That just generally more expensive stocks and stocks with no earnings have come back to earth, with a thud. Having sort of said all of that, I think where we sit now, from a valuation perspective, we still see really good valuation sort of fundamentals in the small mid-cap area. So they're trading on a forward-looking basis, 16.8 times. So they're trading a 40% discount to large cap growth after they've been hit. So we still see a lot of good opportunity there. The earnings recovery is still playing out the way we thought it would, notwithstanding what's happening with a lot of the inflationary issues. And then again, from a quality perspective, we really do feel like this is the environment when these high quality companies with pricing power are going to do really well. Because if you think about the environment, so literally when inflation's spiking the way it is and interest rates are picking up, that's a double whammy for companies that don't have pricing pressure, because they've got too much leverage, they can't pass on inflation. That's still got a way to play out. That's generally pretty bad for value stocks, frankly, because those are the ones that have got that dreaded combination of poor pricing power and leverage. But it is very good for quality. And I was actually just looking at before, but if you look at going back to 96, there's been 7 calendar years when US CPI has been 3% or more. And the MSCI Quality Index is outperformed by about 3.3% per annum in those 7 years. So there's a very close correlation with quality as a style doing well in that environment. So those are a couple of points. And the last point I'd make, it's a long answer to the first question, but I think when we look into the second half of the year, there's still really strong room for optimism. So the rate of inflation, it will dissipate at some point, because at the moment it is coming from everywhere. It's food, transportation, housing, energy, labour, and the collective magnitude is huge. That will dissipate, and I think as that dissipates towards the second half of the year, and you start to see the global macro environment continue to soften, I should say, that will essentially mean there's less pressure on the central banks to keep putting interest rates through. So I think that will be a bit of a relief valve for markets per se. And I also think that the reality is that the pandemic has still been weighing on the global economy for the best part of 2.5 years. I think that will start to dissipate, and so you'll start to see some developed economies start to regain momentum off their own steam in the second half of the year.
Yeah, fantastic. And then expanding on that macro kind of broad theme that we have of inflation, how does that kind of impact your approach into investing? Like, is that one of the 6 factors that you kind of look at, or?
It is. So macro factors come in within our quality score. So what we call our business drivers when we're looking at whether it's like, what's happening. So it's industrials, you're obviously looking at sort of what's happening with PMI numbers, or you're looking at from a consumer perspective, but it does make up part of the quality outlook. So we are cognizant of that. Naturally, we try to steer a bit away from the companies whose earnings are very economically sensitive. And I think that's a really important point to make. And if you look just on page 9 really quickly, and this is just a representation on page 9 of some of the names we hold across, so large cap and mid cap names. Now, all these companies have got great pricing power. That's the main message to leave you with, that I think, and that's when, this is exactly the sort of environment when that pricing power gets rewarded. So we don't want to be too cyclical.
Yeah.
And I think maybe just coming back to, just back on page 5, sorry to jump around, I'm switching back to inflation. But this is a quick sort of chart that shows how our core strategy, which has been going for, this is our 20th year, how it's done in previous periods of inflation. So I think there is that correlation there, and we'd expect that to sort of continue next year. So there is macro slowing. We spoke, I think, on the last time about the fact that China's slowing.
Yep.
And I think what's very different now is that the actual GDP growth differential between emerging markets and developed markets is probably the smallest it's been since I can ever remember, frankly.
Yeah, right.
So that's quite different, and I think that will give some EM investors some pause as to sort of the worthiness of the asset class versus developed markets.
And I think that SMID kind of is still underloved and underowned from a broader perspective in institutional portfolios.
Correct, exactly. And you've obviously had more valuation risk come out in the last 6 weeks, so it almost further underpins the argument.
Yeah, well, we've got some big geopolitical risks coming, and you can tell it's going to hurt EM.
Correct.
And then I guess getting into specifics, it'd be great to kind of know what has changes you've made specifically to the portfolio, or portfolios, I should say, and then why you've made those changes as well.
Sure. So there's a couple of examples just on page 7, and so this is for the Bell Global Emerging Companies Fund, our SMID strategy. So these are just the recent trades we've been doing the last couple of weeks. The main message I'd get across is the fact that we are, for the first time in probably 2 or 3 years, we've got names that we really like are coming back to earth. They're getting oversold. They're getting indiscriminately oversold, and that's triggering really good buying opportunities for us. So we've re-established positions in Hoya, Massimo, Starbucks. We've initiated for the first time a position in a company called Nihon M&A, which is so 2 Japanese companies actually. We haven't had much in Japan for quite a while, but we're finding some good opportunities there. And again, what they've all got in common, those 4 buys, they're on average they're about 36% down from their recent highs. So we've been really patient, and some of these names, like again Hoya, Massimo, Starbucks, we've sold all 3 of those for valuation reasons sometime in the last, say, 2 years, and just been opportunistic. So. And then on the sell side, Cerner's been taken out by Oracle. So it's more of a steady growing healthcare software business that we've owned for a number of years. It had lagged, but again, Oracle saw the value, took the name out. And then Hershey's been a fantastic performer. It's up probably about 35% in the last 12 months. And then more recently has benefited from sort of a weight of money into what's perceived as being more defensive stocks. Hit our price target, we've taken our money and look to redeploy elsewhere. So good opportunities starting to present themselves, which is great. And historically, that's been a great precursor to good alpha generation.
Yeah, fantastic. And then I guess digging into the theme of SMID caps and managing an all cap and a SMID cap strategy.
Yeah.
Can you kind of share how broadly SMIDs is performing relative to, say, growth, relative to value, or some broader indexes? And I know that we've talked about in previous calls about the earnings recession, and that being a big reflection point for, where we can actually see some greater returns for investors.
Yeah, so I think, again, from a style perspective, we call ourselves, page 13 is probably the best indication of the performance of the Bell Global Emerging Companies Fund.
Yep.
So from a performance perspective, and again, this is to December. So again, we call ourselves quality of reasonable price. So we're somewhere in between the extremities of value and growth. And there has been obviously massive divergence between value and growth.
Yep.
We've been saying investors for a long time, you don't need to be at the extremities. Often, the best way to generate consistency is to be in the middle. We've avoided the growth, the really growthy component of our subset. We've avoided for the last year because they've just been way too expensive, and that's proven to be the right thing to do because they've come back to earth with the FUD. So, but I do think so. If we think about last year, so we had a good year last year. We were up 29.8%, so we beat the benchmark. But that was within the context of sticking to our quality process, only investing in companies that have got really good earnings and not overpaying. And the collective of that discipline has probably been a bit of a net drag for us last couple of years. But we do think that style is starting to work back in favour for us now. And then I think, and again, on a forward-looking basis, when we think about what's happened in the start of the year, so the fund is down in January is 5.48%. Versus the benchmark down at 4.45%. That's the Bell Global Emerging Companies Fund. The Bell Global Equities Fund, the all cap strategy is down 4.1% versus 2.2% for the index in January. So, but again, that's against a backdrop of an admittedly imperfect quality, the MSCI World Quality Index, which is down about, I think it's down 2.7 or 2.8% for January. So we probably outperformed that a little bit. So we've performed in line with expectations. In January, we had, energy was up 15%, financials did really well. We've got very little exposure to either. So we performed as we would have expected. But I do think that, going for this year is going to be a year where we're going to see huge earnings divergence in terms of earnings performance. And I think, again, the types of companies we're investing in, these quality companies, and just on the following page 14, and this is again the SMID portfolio, but these companies have all got really good pricing power. And again, that it is when inflation hits, that's when the pricing power actually gets rewarded or not.
Yep.
And so I think you'll see divergence in that. And what's not being priced in my view, is that a lot of the companies that would live in sort of the value cohort, those are the ones, again, they've got the leverage, but they don't have pricing power.
Okay.
And that'll play out throughout the year, I think.
Well, this is a question that's just come through, and it relates to these companies. And Graham's written with some of the specific examples, and maybe using some here, for your target companies where prices have been increased, but there's been no impact to supply or demand. So clients are happy, or consumers are happy to pay that increased price. Is that what you're kind of seeing because the quality of these companies is above anything else?
In a nutshell, yes, they're passing through their inflation, and you've seen that. In the mega cap end, you saw Amazon do that the other day. Yeah, ramping up the Prime memberships without anyone blinking an eye. But you're obviously looking for businesses like, high-end businesses like Montclair in the luxury space, where, frankly, because the target market's so, frankly, wealthy, their pricing sensitivity is neither here nor there. And the same thing could be said for a lot of these companies, that ability to pass on price. And you've seen that a bit with, something like Tractor Supply, where obviously in US retail, there's been some labour inflation, there's been, various forms of inflation coming through. But so far, these companies have been beating their estimates and they haven't been downgrading. And I think that's the big part of it. But that's not the case for everyone. That's not the case for all companies, but you're definitely looking for that pricing power. And again, we're sort of in that early stage because inflation's only really hit hard, in the last couple of months. So it's still got a ways to play out.
And then how analysts at like investment banks and researchers, are they addressing those concerns in their reports, or are they still behind the curve in terms of that earnings stability and growth?
I think they're shell-shocked. frankly. I don't think the reality is we haven't seen the magnitude of inflation that we're seeing now for a very, very long time. And again, because it's so widespread, historic periods of inflation spikes are usually dominated by one or two of energy or whatever. But now, again, like I said before, it's food, it's energy, it's housing, it's labour, transportation, all exactly at the same time. And so I think they're having a hard time, factoring that into their models beyond about 3 months or 6 months. Starbucks and their result. I mean, what created the buying opportunity for Starbucks is they've just copped it all in one go. And to us, that's short term. But I think the sell side has a bit of an inclination towards just assuming in 6 months' time everything just reverts to how it was last year. And so I think there's potentially a bit more risk to probably second half estimates. I think from our perspective, the magnitude of inflation, it will come off. It will come off, but it's not going to disappear.
Okay. And then we've talked through the quality factor. We've talked through the definition that, you'll subscribe to quality. And then I think personally, I've been listening to a number of different market strategists that are also advising clients to kind of tilt to that quality factor. And then I'd be good to kind of get your thoughts on the growth and value factors in a rising rate environment. And you've kind of touched on value not doing so well. And obviously be good to kind of get your thoughts on why growth might continue to struggle and, why there's just going to be that kind of continual overhang until we probably start to see moderation at some point in the future.
Yeah, it's a good question. And a lot of it comes back to two big factors. One being it's the magnitude of growth changing. And the second one being the way those big growth companies are owned, because they're owned very differently to how they were 5-10 years ago. So if you take Meta or Facebook, that's a great example where they had both issues in that the ownership of the company is much more heavily skewed towards obviously growth investors, but also various forms of passive investment. So, so when the stock gets expensive and then the earnings growth dissipates from, call it 15 to 20% a year down to 4%, it all of a sudden becomes a different animal. It's not a growth stock anymore. So therefore, you've got this white space between the growth owners and where the value investors might want to actually come in. And that's why you see the magnitude of these falls being so big. And you've seen it with a bunch of companies, with Meta, with Netflix, with a range of names where you've just seen, pretty severe deceleration in growth after 2 years of very strong growth. But they're so crowded the way they're owned. So, and then I think more generally, if you buy into the idea that we are going to have higher interest rates for longer, naturally that's going to mean that those earnings multiples at the growth end are going to continue to compress. They've come back a little bit, but there's still a long way to go back to the mean in the last 5 years or 10 years. So I think that valuation issue is still a big one. And I just ask myself, I don't know who the marginal buyer is for a lot of these growth companies when they've come down from say 60 times earnings to 40 times earnings. The value guys are still a few floors down the building. So it's just hard to know how that gets held up. And I think we're still probably in the early stages of that. So I think having that valuation sensitivity is really important. Thankfully for us, again, we've probably seen quite a few instances, sort of reference some of them with stocks we've bought, where you've had companies have gone from being moderately overvalued to quite undervalued quite quickly. And that's where we're starting to see more of the opportunities now. But yeah, I think and then obviously within the broader growth cohort, this whole, idea of, I sort of referenced it before, but the idea of sort of emerging markets exposure has obviously been difficult for a while. But again, when you overlay that with a decelerating China's economy and the regulatory issues not going away, that risk doesn't necessarily go away. And so I think, I think people have got to really think long and hard about, it's thinking about the sustainability of growth. And I think investors will gradually move into companies that have got more sustainable growth trajectories of whether it's like 10 to 15% as opposed to growing earnings at 40% every year until it peters out to 2%.
Yeah, okay. Yeah. And we've just got a question on kind of regional coverage.
Yep.
And just your thoughts on Europe, SMIDs or large caps and any kind of comments you might have. We've talked about obviously entering into Japan, which we haven't for a long time.
Yep.
And now kind of Europe would be good to kind of get some comments there.
Yeah, so page 16 gives a quick sort of snapshot of where we are with the Bell Global Emerging Companies Fund. So we are overweight in Europe. The following page on 16. So we are overweight Europe, and so we've got about a third of the portfolio there. We have no Ukrainian or Russian exposure, so just developed markets.
Good to know.
Good to know. But we've essentially been taking profit in North America and rotating more and more into Europe, and that's more from a stock-specific perspective because that's where we're seeing better value for money, frankly. And that's been the case for the best part of the last 12, 18 months. So we still feel that that's the right place to be. The revenue of exposure of a lot of the companies you see on the right is quite diverse. So as much as they're small mid-cap companies, they do tend to have quite diverse revenue bases also. And as we mentioned before, we're just aiming to tip our toe back into Japan. So we feel like the portfolio is well positioned. And from the sector perspective, good absolute diversification too. And just while we're on that really quickly, I think just that following page 17, brings out this is a big question we get about like how we've generated our performance.
Yep.
And obviously, the question we often get is, have you generated all your alpha just from, investing in tech stocks, momentum tech stocks? And the answer's been no. It's actually been a lot more to do with like healthcare names in the last 3 years, Align, Charles River, Mettler Toledo. More recently, some of the consumer names like Tractor Supply, Yeti, Fox Factory, Pool Corp. So from a sector perspective, we think a great thing about our strategy, it tends to complement other growth type strategies that are much more IT centric.
Yep.
And again, these types of positions, they're just not nearly as crowded either, and they don't have the valuation risk.
Yeah, fantastic.
Yeah.
Well, Ned, we're coming up to the 12:55 mark, so I really want to appreciate your time today. I know it was short. There's a lot of stuff going on in the markets today. Yep. Again, if there's any further questions that come to mind, please reach out to your Channel Capital representative on the screen. And thank you for your time during this volatile start to the year, and look forward to doing it again later in the year.
Excellent. Thanks, James, and thanks for joining.